right, welcome back to Iron Financial. This is the place where we help you forge a stronger portfolio and cut right through all the market weakness. And today, we're doing a deep dive on a company that has pulled off one of the most, radical transformations I have seen in a long, long time. I'm talking about a company that used to be this complex, debt-heavy legacy telecom, deeply tied to Russia. And now, it's been completely reborn. It's redomiciled in Dubai, and it just posted a number so explosive that, frankly, we have to talk about it. We are talking about VEON. Now, the market is buzzing, of course. The stock popped, but our job, as always, is to figure out if this is a structurally sound investment or if it's just a new coat of paint on a foundation that's about to crumble. Okay, let's get into it.
So this is it. This is the number that just lit up our screens, 84.1%. I want you to just let that sink in for a second. That is the year-over-year growth in digital revenue that VEON just put up for the fourth quarter of 2025. And no, that is not a typo. In a world where a telecom company getting single-digit growth is considered, a pretty big win, a number like this is a screaming signal. It is proof positive that their whole strategic pivot, their new model, is not just working, it is firing on all cylinders. This is the kind of aggressive, high-margin growth that can turn a boring old utility into an absolute tech powerhouse. Seriously, when a company posts a figure like this, you have to stop and ask, what on earth is going on here? And, more importantly, is there more fuel left in the tank?
Whoa, hold on a minute. Let's pump the brakes before we all get carried away. I mean, look, 84% is a massive number. I will absolutely give you that. But is it real? Is it sustainable growth? Or is it just some kind of statistical fluke? A one-time jump off a really low base that's going to come crashing back down to reality next quarter. Come on, we've seen this exact story play out a dozen times before. A company juices its numbers for a quarter, maybe two, gets a huge pop in the stock price, and then poof, it all evaporates. So the real question, the one that actually matters for our portfolios, is whether this is the beginning of a real long-term trend or just a beautiful but very temporary flash in the pan.
That is the question, isn't it? And that's exactly why we're here. We're about to put this company through the full Iron Financial stress test. First up, we're going to break down how they actually forged this new VEON. We'll look at the strategy, the history, and that critical pivot. Then we get to the heavy lifting. We are going to stress test the financials to see what's really hiding behind that 84% number. After that, you'll get your chance to point out all the cracks in the armor. We're talking risks, headwinds, the full bear case. And finally, we will bring it all together for the Iron Financial verdict. All right, let's get to work.
Okay, so to really understand where VEON is headed, you have got to understand where it's been. See, this isn't some hot new tech startup that just appeared out of nowhere. This is a decades-old company that basically had to demolish its old identity, tear it down to the studs to build something completely new. This section is all about that blueprint, the foundational work they put in to pivot away from what was, let's be honest, a dying business model and transform into a high-growth digital operator. This is the origin story of that 84% growth number. So let's just trace this history real quick. VEON started its life way back in 1992 as VimpelCom over in Russia. For years, they expanded like crazy, but the company was always, and I mean always, weighed down by the complexity and the geopolitical risk of its Russian business. It created this thing analysts called the Russia discount. It didn't matter how well the other parts of the business were doing, that anchor was always holding the company's valuation down. The big moment, the move that changed absolutely everything, came in 2023 when they finally completed the sale of those Russian assets. It was a clean break. They packed up, moved their headquarters to Dubai, and in 2024, the market finally woke up and took notice. The stock went through a massive re-rating because for the very first time, investors could value the company based on its high growth potential in these frontier markets, not on its troubled past.
So after shedding that old skin, what did they build? Well, they built this. It's called the Digital Operator 1440 strategy. The name's actually pretty clever. It comes from the 1,440 minutes in a day. The entire strategy is built around one idea, capturing a much bigger slice of a user's daily life. It's not just about providing a cell signal anymore, it's about building a whole super app ecosystem on top of that connection. They bundle their core connectivity, the pipes and the minutes, with high-margin digital services like mobile banking, streaming shows, even telemedicine. This is the blueprint. It makes customers stickier, it drives way more revenue per user, and, most importantly, it shifts their whole business model from being a low-margin utility to a high-margin tech platform.
Okay, I have to jump in here. The strategy, it sounds impressive on paper, but let's take a hard look at where they're building this so-called digital empire. Pakistan, Ukraine, Kazakhstan, Uzbekistan, Bangladesh. This isn't exactly the Swiss banking district, is it? We're talking about some of the most geopolitically volatile, economically unpredictable regions on the entire planet. So while you look at that and see a total population of over 500 million people, you know what I see? I see a minefield of currency risk, regulatory chaos, and, oh yeah, in the case of Ukraine, an active war. Are we really sure building on this kind of ground is a smart move? It feels like one political crisis, one bad headline, could bring this whole structure crashing down. That's the classic risk-reward of frontier markets, though. Of course, the risk is elevated, but the opportunity is absolutely immense. These are nations with massive, young, digitally native populations that are completely underserved by traditional banking and tech. While Western markets are totally saturated, these digital nations represent a huge, untapped runway for growth. VEON is essentially building the digital backbone for the world's next emerging middle class. It's a high-stakes gamble, there is no doubt about that, but the potential payoff is just enormous.
All right, that's enough about strategy and history. Let's get down to the bedrock of any solid investment case, the numbers. This is where we do the real heavy lifting. This is where the story either holds up or completely falls apart. We are about to rip into the Q4 2025 earnings report and see if the financial structure is as strong as the narrative they're selling us. You know, it's easy to talk about strategy. It's a lot harder to fake financial performance. Let's see what the data actually says.
Okay, now check this out. What's really fascinating here is the dual engine growth. We've already hammered that explosive 84.1% digital growth number. But look at the total revenue, up 17.4% year over year. What that tells us is that the core connectivity business, the old telecom stuff, isn't just sitting there collecting dust. It's still growing at a very, very healthy clip. So this isn't a story of some new venture eating the old one for lunch. No, this is a story where both the established core and the new digital ventures are firing in sync. It's creating this powerful top-line momentum across the entire business.
Right, but revenue is a vanity metric. We all know that. Profitability is sanity. I mean, anybody can buy revenue if they're willing to slash prices or just spend a fortune on marketing. I want to know if this 17% growth is actually translating into hard, cold profit. Are their margins expanding, or are they getting totally crushed? Show me the operational leverage. Is the company getting more efficient as it gets bigger, or is it just burning through cash to put a big, flashy number on the board?
Challenge accepted. And this slide, well, it illustrates the answer perfectly. Just look at the EBITDA growth, 29.1%. That is growing significantly faster than the 17.4% revenue growth, and that is the literal definition of positive operational leverage. It means for every new dollar of revenue that comes in the door, a larger and larger chunk of it is dropping straight to the bottom line. And as you can see, that resulted in some serious margin expansion year over year. This is not a company that's just burning cash for growth. This is a disciplined, efficient operator that's converting top-line strength into real, tangible profitability. This is the sign of a durable, well-built operation.
Now, let's pop the hood on that 84% growth number and see what's actually powering the engine. Let's break down that $759 million in annual digital revenue. See, this isn't just one-hit wonder. It's a diversified portfolio of services. The absolute giant in the room here is financial services, clocking in at $425 million. This is their fintech engine, and it is clearly the most mature and impactful segment they have. But they're also building solid businesses in enterprise services, healthcare, and entertainment. This diversification is so crucial. It means they aren't totally reliant on a single product, which creates multiple paths for future growth and really de-risks the digital segment as a whole. Okay, hold on. A 10% of GDP figure is... I have to admit, that's a powerful number. It's one thing to have a popular app, it's something else entirely to become systemically important to an entire country's economy. Exactly. This isn't just an app you use for fun, it is becoming essential financial infrastructure. I mean, when your mobile wallet is processing transactions that are equivalent to a tenth of the entire country's economic output, you've achieved a level of market penetration and dominance that is just incredibly difficult to disrupt. You're not just a company anymore, you're basically a utility. This is the kind of deep, structural moat that builds real, lasting value. And if you needed any more proof, here's the CEO, Kaan Terzioglu, basically putting a capstone on this whole transformation story. This quote says everything you need to know. The inflection point has been crossed. This is no longer a telephone company that just happens to have a few apps on the side. It is now, officially, a digital-first company where more people use its digital services than its traditional phone services. The transformation isn't coming anymore, it is complete. Their identity has fundamentally and permanently shifted. And the crucial point for us is that investors need to start valuing it that way.
Okay, fine. The growth is profitable. I'll give you that. The transformation is real. But all of this, It could just be a house of cards if the foundation, the balance sheet, is weak. A company that's growing this fast in such volatile markets can easily get over-leveraged. All it takes is one economic downturn, one currency crisis, and a heavy debt load can sink the entire ship. So let's talk about leverage. How much debt are they actually carrying? Is this foundation made of solid iron, or is it built on sand?
This number right here answers your question. 1.09x. That is their lease-adjusted net debt to EBITDA ratio. To put that in perspective for you, in this sector, anything under 3x is considered healthy. Anything under 2x is considered strong. At 1.09x, well, that's a fortress balance sheet. It's an incredibly comfortable, totally manageable level of debt that gives them immense financial flexibility. They can withstand economic shocks, they can keep investing in growth, and they can return capital to shareholders. This is not a company that's at risk of drowning in debt. This is a company with a rock-solid foundation.
And that low leverage, it's supported by an absolute fire hose of cash. They produced $624 million in equity-free cash flow in 2025. This is what mature, well-run companies do. They're not just growing, they're gushing cash. And what are they doing with all that cash? They're rewarding their shareholders. They completed a $100 million buyback, then immediately launched a second one. And they have a stated policy of returning at least $100 million a year. These are not the actions of some reckless growth-at-all-costs story. This is the sign of a disciplined capital allocator that's focused on delivering long-term value to its shareholders.
All right, I'll concede the point. The financials are strong. The balance sheet is solid. The growth is profitable. But no financial model, no matter how good it is, can fully price in the kind of external risks we're looking at here. So far, we focused on the company's internal performance, everything it can control. But now we need to look outward, at the environment it's forced to operate in. Because a fortress is completely useless if it's built on a seismic fault line. It is time to talk about the very real cracks in this armor.
Yeah, let's be really clear and systematic about the bear case, because these are not small concerns. First, geopolitical instability. Their Ukrainian operation, Kyivstar, is a crown jewel asset. It generates huge cash flow for them. But it's operating in an active war zone. That means there's direct physical risk to their cell towers, their infrastructure, and their people every single day. One missile can wipe out millions of dollars in assets. Second, currency volatility. This is the silent killer for anyone investing in frontier markets. VEON reports its earnings in US dollars, but it makes its money in Pakistani rupees, Ukrainian hryvnia, and Bangladeshi taka. A sudden 20% devaluation in the rupee, which, let's be honest, is not uncommon, can wipe out a huge chunk of their USD earnings overnight, and it's completely out of their control. And third, regulatory hurdles. These are not stable, predictable markets. A government facing a budget shortfall can wake up one morning and just decide to slap on a new tax or change the rules of a critical spectrum auction, destroying value in the blink of an eye. This is a minefield, and any one of these risks could be catastrophic.
That's a fair and very accurate assessment of the risks. They are significant, and they absolutely should not be ignored. So now, we bring it all together. You've got the explosive, profitable growth on one side of the scale, and you've got these severe external risks on the other. It is time to weigh the bull case against the bear case and deliver the final iron financial verdict. Is this a generational opportunity, or is it just a well-disguised trap?
And to counter those risks, the bull case points to a pretty clear pipeline of near-term catalysts that could drive this stock significantly higher. For one, there is persistent talk of a separate NASDAQ listing for Kyivstar once the conflict stabilizes, which could unlock massive shareholder value. Their move to Dubai also puts them squarely on the radar of these deep-pocketed sovereign wealth funds in the Gulf, which opens the door for all sorts of partnerships or even M&A activity. They're also just starting to monetize their localized AI models, like KazLM in Kazakhstan, turning them into B2B services. And they keep making these smart strategic acquisitions, like ride-hailing and health tech companies, that expand their super app ecosystem and just keep feeding that growth engine. These aren't just pipe dreams. They are concrete, actionable catalysts just over the horizon.
All right, now let's look at what management itself is forecasting for 2026. They're guiding for 9 to 12% revenue growth. That's right in line with, and could even accelerate from, the 9.9% they just delivered for 2025. That shows a ton of confidence and sustainable, robust momentum. Yeah, I see that, but hang on. Look at the EBITDA growth. They just did 18.8% in 2025, and now they're guiding for just 7 to 10% for next year. That is a significant deceleration. To me, that suggests the massive margin expansion we just saw is pretty much over, and they're entering a period of heavier investment. That's a flag that says the easiest gains have already been made, and future growth is going to be more expensive to get. Or it could be a sign of very conservative guidance from a management team that has a solid track record of under-promising and over-delivering. They're also lowering their CapEx intensity, which signals improving capital efficiency. I see this as a healthy, sustainable outlook for a company that's just come off an absolute monster of a year.
So there you have it, the entire investment case, laid out right next to each other. The bulls see a deeply undervalued digital powerhouse. They see explosive, profitable growth, a fortress balance sheet, and a valuation that is still trading at a discount to its peers. While the bears see a house of cards that's been built in some of the world's most unstable regions. They see crippling currency and geopolitical risks that you simply cannot ignore, a history of volatility, and clear signs from the company's own guidance that the peak growth rate is now in the rearview mirror.
And that brings us to the final and most crucial question. VEON has, without a doubt, successfully forged a new identity. The numbers are undeniably strong, the balance sheet is solid, and their digital strategy is clearly working. But the risks are just as real and just as big as the potential rewards. This is the very definition of a high-risk, high-reward frontier market play. So the question you have to ask yourself is this. Is VEON's high-stakes gamble in the world's frontier markets a risk that is worth taking for your portfolio? Well, the answer to that is going to depend entirely on your own tolerance for volatility and your belief in the durability of this incredible turnaround story. That's all for this edition of Iron Financial. Do your own homework, stay strong.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.